us, Andrew Holland, CEO at Avendus Capital Public Markets Alternate Strategies LLP, joining in. Welcome to the show, Andrew, and always a pleasure to speak to you. And festivity wishes from Nirmal Bang family to you as well.
Well, thank you very much for inviting me, and it's an absolute pleasure from my side. And I wish you and families and anyone who's watching a very happy Diwali.
Thank you, Andrew. Andrew, let's start with what's happening in the markets right now. The kind of highs that we've seen in the last 1 year. Yes, there have been small bouts of correction that have started to creep in. What do you make of this entire market scenario right now?
Well, it's kind of I think caught us all a little bit by surprise in terms of the latter move, the kind of last part of the move, because I don't think we were expecting retail investors to be as strong as they are today, and I think that's the not just for India. I suppose that's happening globally as well. But if you would have asked me 6 to 9 months ago, would you see the scenario where SIPs were $10 to $12 billion a month, and you would see new fund offerings raising 10 to 12,000 crores? Probably the answer would have been no. So the good news is that the retail investors in there is investing and investing for the long term, not just the short term. And I think that's added the extra liquidity which the market was probably needed to move to the highs where we see, and along with obviously the fact that there's been problems along in China and other emerging markets. So India stood out, and even though we had a correction last month on the highs of around 5%, we're still one of the best performing markets globally. So you can't really fight that kind of strength in the market at the moment.
Right. So overall, do you think there is some bit of fatigue that is creeping in, and the risk reward was more to the downside?
I think the risk to the downside last month was certainly there, and we saw that at the back end of the month. But again, we'll see how liquidity kind of plays out in the next few months. We've got some big events coming up. We've got the Fed and tapering. We're still not out of the woods with inflation. There's debates now whether it's stagflation. So there's many kind of worry points out there. And for India, the results season so far has been good, but the commentary again is slightly more cautious because of the impact that it's having on corporate margins in terms of input costs, or because of delays in delivery of services or goods. So all of these factors, I think, will probably mean that earnings don't get those upgrades that we've been used to over the last 1 year. But we haven't seen any downgrades yet, so that's the good news. So I think we might just consolidate for a little while, and that wouldn't be a bad thing either, to be honest.
Right. So how do you think our FIs viewing the market? Do they still find India to be attractive versus China, or do you think they find China cheaper to India on the valuation front? And if that's so, do we see profit taking to happen in terms of Indian markets to continue?
Yeah, see, if you have a global correction, which could come at any time, for all the various reasons we just mentioned, then India would be seen as for FIIs as a market that's done exceptionally well and can take some profits off the table. So if you're holding China, which hasn't performed, and you have a neutral weightage, then you probably would want to take some weight away from India, where you maybe have an overweight. So it's all relative. So I think FIIs are seeing that other emerging markets are cheaper than India, but obviously India gives them the stability, and it also gives them one other new thing at the moment, which they didn't have, up until say 4 or 5 months ago, was all these new technology disruptive type companies coming to the market, and they can't really play in China as much as they did. So India is becoming the playground for new investments into these kind of sectors. And India obviously has similar sized population all the kind of demographics work in India's favor along with China. So I don't think money will stay away for too long from India. But if you have a market sell-off globally, then I think India would be used as maybe take some profits off the table rather than other emerging markets.
Right. And with global markets as well, how do you see them playing out, say, in the next 9 to 12 months? Are there any risks apart from the tapering that we need to watch out for? And any risks, are they priced in terms of the market rally or the market valuation right now?
So, whenever I've kind of gone through this and said, okay, let's just take two of the risks. Let's say there's an inflation risk. Now, the market is saying that's okay because if inflation's there, then growth is there. So that's good for the markets, right? And you'll continue to see liquidity flow to equities because of that. On the other part, if I say, well, okay, I think that instead now it's not going to be a supply chain problem. It could well be a demand problem because, people will just spend less. We've all done our spending, our kind of pent-up spending that we've done, and we'll go back to norm as we go back to the office, as we go back to school. We'll start to go into our normal patterns of spending and so forth. Now, if I take that scenario, which means that growth forecasts will have to be lowered globally, then the market's going to say, well, okay, well then interest rates probably don't need to rise as quickly in the future. So that's good for equities. So at the moment, everything is seen as good for equities. So there's going to be something that will change that narrative. It could be many various things. It could be, commodity prices remain high, or stagflation really does start to gather pace. And that would be the concern. And I don't think the market's baking in any of those scenarios. It's only baking in the rosy part of that scenario. And I'm sure if we have a growth slowdown, that would have an impact. And I can't see that China will not have an impact on global growth. So I think markets are a bit too rose-tinted in their glasses at the moment. And we need to see a little bit more kind of concerns.
Right. So overall, if we do continue to see some bouts of correction, how much should an investor pencil in now?
We've been thinking anywhere between 5 to 10%, and if I take last month, it's only from the highs, like we were down 5%. So I think anywhere between 5 to 10% wouldn't be a bad gauge, to be saying, okay, maybe the worst is over, depending on what is forcing the markets down.
Right. And overall, if we continue to see this bout of correction, what are the kind of buying opportunities that you're trying to pick and choose?
This is going to be the key to investing over the next year is what are the themes or what are the sectors which are really going to lead going forward? Because it's been rotational over the past year, which has been good in some respects. But let's say, for example, if you want to buy into autos, and you're thinking about the EV sector, for example, the electric vehicle segment, do you take a bet on the companies, which are who's going to be the winner? I'm not sure. I think it's going to evolve, and there's going to be a few winners come out of it. What I do know though is that the auto parts suppliers are going to supply everybody, right? In terms of the winners and the losers from that. So, if I was to play EVs, I'd probably go for more auto parts. So I think you need to look at what are the themes which you think will play out within the sector, and which are the companies which are going to be the best best placed to really kind of benefit from that. And I think that's how it's going to be. It's a little bit more theme invested. I don't think you can just say, well, okay, infrastructure spending, it's got to be XYZ company. You got to look at where that spending is going, because it's going into different places and just roads and highways and bridges than it used to be. So I think those are the kind of things that you have to start to think about a little bit more.
Right. So overall, right now, Andrew, if you have to look at divided, say, between different sectors, do you think sectors where you will see a lot of government spending happening, are those the sectors which one should bet on? Because that's something which is yet to kick in. And secondly, you have the consumption-driven stocks, which have already seen an up move. Pharma has seen a good move in terms of especially, and you have specialty chemicals as a theme, which has seen a good run in the last 1 year as well. So taking that entire concentration and rotation factor into consideration, which would be those top 3 to 4 sectors which you would pick and choose?
So I think that the top sectors for me would be the financial sector. Now, I would traditionally say to you, the private banks and so forth. Now, I would say that you'd always need some of those private banks, because if our economy is going to be a $5 trillion economy, we need a big banking sector. But, rather than kind of look at MBFCs, I'd probably look at the insurance, the life insurance, health insurance, and the asset management companies, because again, I think it's a theme within that financial disbursement of our assets going forward. We're going to, after COVID, I think we're all going to take more care of our health, so we're going to have more insurance and so forth and so on. And obviously, what we talked about at the beginning was more and more people coming to the markets through mutual funds. It's going to be great for asset management companies. So I think that's one theme I think will play through. I think the other theme would be, and it's a selective theme, is obviously, some of these new companies coming to the market, which are disruptive in nature. We've seen Zomato, we've got Nike coming up. These are the kind of companies, where you need to be looking not just at the valuations today, because I don't think they really matter, but where you think they might be in 3 to 5 years' time, the size of that opportunity, and will these companies be in that same position as they are today in terms of being dominant? So I think a theme around some of the new listings and there, because it will go across different sectors. So it's not just one specific sector. I think will pay huge dividends over the next 2 to 3 years. I think within the auto sector, I mentioned, the auto parts suppliers. And I think I would continue with the kind of telecom, kind of digital areas where, again, I think we're all using more and more technology, and I think that's not going to go away from us. And the pricing power is back with the telecom companies. So I think so I think that's a sector which I think will continue to do well. I'm a little more neutral on kind of IT and pharma at the moment. Valuations are pretty stretched, but I think pharma does have those tailwinds going forward for many years ahead now, in terms of being back on the map, back on the global map, for manufacturing, and I think that's been something which has been missing for some time. So I wouldn't kind of dismiss it, but I'm just in the very short term, the valuations look a little bit rich for me.
Right. And overall, if you have to look between large caps and mid caps, do you think it's the mid caps and the small caps where there will be more value and growth that would be seen?
Our fund mainly deals in large caps, but so that's obviously our bias. But you will get many great small and mid cap companies emerging through this time, and I'm sure a lot of new names which we didn't know about 6 months ago, even 6 months ago, are starting to emerge. I think the sector I'd love to play a little bit more would be the real estate sector, but it's very limited in terms of what is available to buy in terms of direct exposure. So you have to kind of play it through the material side of it, and that lends itself again more to the kind of mid and small cap companies, whether it's from piping to paints to so forth. So that's the way I'd look at the kind of small and mid cap sectors as well. Again, what are the the kind of themes that are going to play through? And yes, if you've got a large cap company there, that's great because they will dominate. But is there any companies below that who can also carve a niche going forward in a very strong kind of growth tail, growth wind, which these sectors will enjoy.
Right. And very lastly, Andrew, what are the kind of return expectations that you have from Nifty Sensex over the next 1 year?
I think anywhere between 10 to 15% would be I think a reasonable outcome from here, at these levels. I think what would change that, what would make it better, would obviously be if, and we're starting to see it, but if foreign direct investment into India really picks up pace, then that will have an extra multiplier effect onto the economy in terms of investments and whether it's in manufacturing and so forth. So that might kick off the private capex cycle a little bit quicker. So I'll be watching that very carefully, because that would be the extra fillip the economy needs. And as you rightly said, the government's just about to start spending.
Right.
That will be the extra kicker. And if we get foreign direct investment as well, and then private investment, you could be back to those, if you remember those 2007 days when we had all of those multiplier effects up in the economy.
Absolutely. And I think this is the time where we need to watch out for from a longer term perspective with regards to investments, and probably not take short term bets as well. Thank you, Andrew, so much for joining us on the show. Always a pleasure to speak to you, get insights. Happy Diwali and a prosperous New Year once again, and speak to you soon again.
Yes, thank you, and Happy New Year.